Built to Rise. Success Principles for Melanated People and People of African Descent. Written by Langston E. Hughes. Chapter 9. Money, Credit, Capital, and Wealth Building. Wealth is not only earned, it is organized, protected, multiplied, and transferred. Money is one of the places where belief becomes visible. People can speak power, purpose, faith, and freedom, but their money will often reveal the actual system they are living by. Money shows habits. Money shows fear. Money shows training. Money shows avoidance. Money shows values. Money shows whether a person is thinking only about today or also about tomorrow. Money shows whether a household is organized or simply reacting. This chapter is financial education, not personal financial, legal, tax, investment, or insurance advice. Every household has different income, debt, family obligations, health needs, immigration status, business structure, tax situation, risk tolerance, and goals. Use this chapter as a framework, then seek qualified professionals when the decision is serious. A reputable financial counselor, tax professional, attorney, insurance professional, investment advisor, lender, or credit counselor when appropriate. The purpose here is to build financial literacy and financial courage. For melanated people and people of African descent, money cannot be discussed only as personal choice. History matters. Enslaved labor, land loss, wage theft, exclusion from fair lending, housing discrimination, employment discrimination, unequal schools, predatory products, medical debt, and gaps in inheritance have shaped financial life across generations. Many families were not simply careless with money. They were denied the same opportunities to own, borrow, insure, invest, and transfer wealth. But history cannot become the end of the conversation. If we stop at what was denied, we may fail to organize what is available. The goal is not shame. The goal is structure. Money must be earned. Money must be tracked. Money must be directed. Money must be protected. Money must be multiplied. Money must be transferred. That is wealth building. Money is a tool, not a master. Money is not evil. Money is not holy. Money is a tool that reveals the hands and heart using it. In confused hands, money can create more confusion. In fearful hands, money can hide. In wounded hands, money can become performance. In undisciplined hands, money can disappear. In greedy hands, money can exploit. In wise hands, money can build. Money can fund education. Money can buy time. Money can protect elders. Money can support children. Money can acquire land. Money can start businesses. Money can preserve health. Money can create options. Money can support spiritual and cultural institutions. Money can turn compassion into infrastructure. This is why people of African descent must become serious about money without worshiping it. Poverty is not righteousness. Wealth is not wholeness. Money is a servant that must be trained. If money is not given an assignment, impulse will assign it, fear will assign it, advertising will assign it, family pressure will assign it, emergency will assign it, shame will assign it, status anxiety will assign it. Every dollar needs direction. The financial inventory: you cannot organize what you refuse to see. The first step is a financial inventory. This may feel uncomfortable, especially if money has been connected to shame, conflict, or fear. Do it anyway. Looking is an act of power. Write down monthly income from all sources, fixed monthly expenses, variable monthly expenses, debt balances, debt interest rates, minimum payments, savings balances, retirement accounts, investments, insurance policies. Credit score ranges if known. Credit report issues. Business income and expenses if applicable. Assets owned. Money owed to you. Money you owe to others. Upcoming obligations. Financial dependence. This is not a judgment. It is a map. If you were lost in a city, a map would not shame you. It would show you where you are so you can choose the next road. Many people avoid financial inventory because they are afraid the numbers will confirm failure. But numbers are not identity. Numbers are information. A low balance is information. A high interest rate is information. A missed payment is information. A spending pattern is information. Information can be used. Avoidance is more expensive than truth. Budgeting is not punishment. A budget is not punishment. A budget is a plan for your money before pressure, impulse, or confusion takes over. Some people resist budgeting because it feels restrictive, but a budget can create freedom. It helps you spend without constant guilt because you already know what money is for. It helps you say no without drama. It helps you identify leaks. It helps you prepare for known expenses instead of treating them like surprises every month. Use whatever system you will actually use: a notebook, a spreadsheet, a budgeting app, envelope categories, separate bank accounts, automatic transfers, weekly money meetings. The tool matters less than the habit. Begin with categories: giving and community commitments, housing, food, transportation, utilities, insurance, debt payments, savings, investing, health, children and family, education, business, personal care, joy, irregular expenses. A good budget includes joy. If a budget has no room for any joy, many people will rebel against it. The issue is not enjoying life. The issue is making sure enjoyment does not steal from stability, health, ownership, and future freedom. Budgeting asks what must be paid, what must be saved, what must be reduced, what must be increased, what must be planned before it becomes a crisis, what spending is aligned with purpose, what spending is emotional leakage. Do not build a budget to impress anyone. Build one you can live with and improve. The emergency fund. An emergency fund is money set aside for real emergencies: job loss, car repair, medical needs, urgent travel, housing issues, equipment failure, or family crisis. An emergency fund does not make life trouble-free. It makes trouble less destructive. Start small if necessary. A first goal may be $250, then $500, then $1,000, then 1 month of basic expenses, then 3 months, then more depending on your household needs, income stability, dependence, business risk, and health. Some people delay saving because the amount they can save feels too small, but small saving builds the muscle. $10 saved consistently is not only $10, it is evidence. $25 saved automatically is not only $25, it is a vote for stability. An emergency fund is not built from leftovers alone. It is built by paying the future first, even if the amount is humble. Automate it if possible. Make it boring. Do not keep it where impulse can easily spend it. Do not call every desire an emergency. The emergency fund is a boundary around your future. Credit is a tool. Credit is not money. Credit is access to borrowed money under terms. Used wisely, credit can help a person buy a home, start or grow a business, manage timing, finance education, purchase a vehicle, or handle large needs. Used poorly, credit can become a trap that charges tomorrow for yesterday's impulse. The Consumer Financial Protection Bureau explains that credit reports and credit scores affect finances, and that checking credit reports at least once a year helps identify errors that could affect access to credit or loan terms. It also provides guidance on disputing errors and understanding rights. Credit reports matter because lenders, landlords, insurers in some contexts, and other decision makers may use credit information. Errors can cost money. Ignorance can cost opportunity. A basic credit plan includes: check your credit reports, dispute errors in writing, pay bills on time, keep credit card balances low compared with limits, avoid unnecessary hard inquiries, keep older positive accounts open when appropriate, use credit for strategy, not emotional spending, know interest rates, read terms before signing, avoid predatory products, Credit repair should be approached carefully. Be cautious of anyone promising instant results, new identities, guaranteed deletions, or asking you to lie. Reputable credit counseling focuses on education, budgeting, repayment, and lawful disputes. Credit is not a moral score. It is a financial tool and reporting system. Do not worship it. Do not ignore it. Learn it. Debt, good, bad, and dangerous debt is not all the same. Some debt can help acquire or build an asset when the terms are wise, the payment is manageable, and the purpose is clear. A mortgage may help purchase a home. A business loan may help buy equipment that produces income. A student loan may support education that increases earning capacity, though the cost must be carefully weighed. A vehicle loan may be necessary for transportation, but it can also become a burden if the payment is too high. Other debt is destructive. High-interest consumer debt, payday loans, cash advances, rent-to-own traps, unnecessary buy-now-pay-later stacking, and emotional credit card spending can drain a household. Ask before taking debt, what is the interest rate? What is the total cost? What is the monthly payment? What happens if income drops? Does this debt buy an asset, fund growth, or only satisfy impulse? Is there a cheaper way? What are the fees? What happens if I pay early? What happens if I pay late? Can I explain this debt to someone wise without embarrassment? Debt should be evaluated by purpose, terms, risk, and capacity. If you already have debt, create a debt plan, list every debt. Include balance, minimum payment, interest rate, and due date. Choose a repayment strategy. Consider the avalanche method. Pay extra toward the highest interest debt first while making minimum payments on the rest. Consider the snowball method. Pay extra toward the smallest balance first to build momentum while making minimum payments on the rest. Call lenders if hardship is real. Avoid taking new debt while trying to escape old debt unless it is part of a wise consolidation plan. Celebrate paid-off balances. Debt freedom is not only financial. It is emotional. It gives the mind space. Real-world example. Maggie Lena Walker understood that money, trust, and institutions must be organized. The National Park Service describes her as a bank president, newspaper editor, fraternal leader, and advocate for economic empowerment and educational opportunity in Jim Crow-era Richmond, Virginia. Through her leadership, she helped build institutions that served people of African descent when existing systems often denied dignity and access. Her work with banking is especially important for this chapter. A bank is not merely a building. It is a structure of trust, savings, lending, record-keeping, and community possibility. Walker's vision recognized that pennies could become dollars, dollars could become loans, loans could become homes and businesses, and financial education could become community power. This is the lesson: money must be institutionalized. It is not enough for individuals to earn. Communities need banks, credit unions, loan funds, investment circles, insurance knowledge, business training, trustworthy advisors, and habits of saving and ownership. Walker did not simply tell people to believe in themselves. She helped create structures where belief could become financial action. Modern readers should ask, where do I bank? And why? Do I understand the tools my financial institution offers? Does my community have trustworthy financial education? Are children being taught to save? Are local entrepreneurs connected to responsible capital? Are elders protected from exploitation? Are families creating wills and beneficiary plans? Are we organizing money or only reacting to bills? Walker reminds us that financial dignity requires both personal discipline and community institutions. Saving and investing are different. Saving and investing are related, but they are not the same. Saving is setting money aside, usually for shorter-term needs, safety, emergencies, and known expenses. Savings should generally be accessible and protected from major market swings. Investing is putting money into assets with the goal of growth, income, or long-term wealth. Investing carries risk. Values can rise and fall. There are fees, taxes, timelines, and choices to understand. FINRA's investor education materials emphasize setting investment goals, knowing your time frame, being patient, learning what you invest in, understanding fees, and using asset allocation and diversification so you do not risk everything on one investment. This is practical wisdom. Do not invest rent money. Do not invest emergency money. Do not invest because a stranger on the internet is excited. Do not invest in something you cannot explain. Do not confuse gambling with investing. Do not chase quick riches because you are tired of slow discipline. Investing should begin with education. Learn stocks, bonds, mutual funds, exchange-traded funds, retirement accounts, employer plans, individual retirement accounts, fees, taxes, risk tolerance, time horizon, diversification, compound growth. The goal is not to become a Wall Street expert overnight. The goal is to stop being financially defenseless. For many people, workplace retirement plans can be an accessible starting point, especially when an employer match is available. An employer match is not free in the emotional sense. It is part of compensation. If you can responsibly contribute enough to receive it, study that option carefully. Investing is a long conversation with time. Begin learning early. If early has passed, begin now. Capital, money with an assignment income pays for life. Capital builds capacity. Capital is money or resources used to produce more value. It can fund equipment, inventory, land, education, technology, marketing, staff, licensing, product development, or business expansion. It can also be social capital, relationships, reputation, trust, and access. It can be intellectual capital, knowledge, methods, patents, books, courses, and systems. A major shift happens when a person stops seeing every dollar as spending money and begins seeing some dollars as capital. Spending money says, "What can I buy?" Capital says, "What can I build?" Spending money says, "How do I feel better today?" Capital says, "What future capacity can this create?" Spending money disappears. Capital is sent on assignment. Examples: buying a tool that increases your earning capacity, paying for a certification that leads to higher income, funding a website that brings clients, buying inventory with clear sales demand, saving a down payment, hiring a bookkeeper so the business can see profit clearly, purchasing a camera to produce paid video work, investing in a retirement account for long-term growth, paying legal fees to protect intellectual property. Capital must still be used wisely. Not every course is worth the cost. Not every business idea deserves funding. Not every tool is necessary. Not every investment is appropriate. Capital needs due diligence. Ask, how will this create, protect, or multiply value? What is the realistic return? What is the risk? What happens if it fails? What knowledge do I need before committing? Who has experience with this? Capital without wisdom can become expensive ambition. Business funding should match the stage and purpose of the business. Some businesses need very little money to begin. A service business may start with skill, tools, a simple website, insurance, and basic marketing. Other businesses need equipment, inventory, vehicles, space, staff, licensing, or technology. Possible funding sources include personal savings, customer pre-sales, side income, family or friends with written agreements, microloans, community development, financial institutions, credit unions, small business loans, SBA-backed loans, grants when truly available and appropriate, investors if the business model fits, crowdfunding, revenue reinvestment. The Small Business Administration provides information about loan programs and funding options, but business owners should remember that loans must be repaid. A loan is not a blessing if the business cannot support the payment. Before seeking funding, prepare business plan, clear offer, customer evidence, revenue model, budget, bookkeeping, credit review, legal structure, tax awareness, use of funds, repayment plan, personal financial stability. Too many people ask for capital before proving the business can use capital well. Money magnifies systems. If the system is organized, money can help it grow. If the system is chaotic, money can make the chaos larger. Insurance protects the assignment. Insurance is not exciting, but it is important. Insurance transfers certain risks, so one event does not destroy everything. Different households and businesses need different coverage. Learn the basics and speak with qualified professionals. Common types include health insurance, life insurance, disability insurance, auto insurance, homeowners or renters insurance, business liability insurance, professional liability insurance, property insurance, key person insurance for businesses. Insurance should be connected to responsibility. If people depend on your income, life insurance may matter. If your body earns your living, disability coverage may matter. If you operate a business, liability coverage may matter. If you rent, renter's insurance may protect belongings. If you own property, proper coverage matters. Do not buy products you do not understand. Ask questions: what is covered, what is excluded, what is the deductible, what is the premium, what causes a claim to be denied, how much coverage is enough, can I afford this long term, how is the agent paid. Insurance is not wealth by itself. It is protection around wealth, income, health, and family. Estate planning is love with paperwork. Estate planning is not only for wealthy people. If you have children, property, bank accounts, a car, business interests, life insurance, retirement accounts, creative work, family heirlooms, digital assets, or strong wishes about medical decisions, you need some form of estate planning. Estate planning may include a will, beneficiary designations, power of attorney, healthcare directive, trusts when appropriate, guardianship decisions for minor children, business succession plan, life insurance review, funeral wishes, digital account instructions, property records. Estate planning prevents confusion. It can reduce family conflict. It can protect children. It can keep assets from being lost unnecessarily. It can make grief less chaotic. Many families of African descent have lost property because paperwork was missing, heirs disagreed, taxes went unpaid, titles were unclear, or no one knew the plan. Land and homes can be lost when love is present but documents are absent. Do not leave your family with mysteries. Write things down. Update beneficiaries. Talk to an attorney when needed. Keep documents accessible to the right people. Have the uncomfortable conversation. Estate planning says, I love you enough to be organized. Children and money. Children should learn money early, not with fear, not with shame, with practice. Teach them money is earned through value. Money must be counted. Money can be saved. Money can be spent wisely. Money can be given. Money can be invested. Money can be wasted. Money can be used to build. Give children age-appropriate financial responsibilities. Let them save toward goals. Let them compare prices. Let them learn the difference between need and want. Let them see adults budgeting without panic. Let them hear conversations about ownership, not only bills. Use jars, envelopes, apps, bank accounts, or notebooks. The method matters less than the lesson. Teach children to ask, how much does it cost? How long did it take to earn this? What else could this money do? Is this a need, want, tool, asset, or gift? How can I create value? A child who learns money as a tool is less likely to worship it or fear it. The family money meeting. A family money meeting can change the culture of a household. It does not have to be long. Start with 30 minutes once a month. Discuss income, bills, savings, debt, upcoming expenses, family goals, children's needs, giving, business ideas, progress, lessons learned. Keep the tone calm. Do not turn the meeting into blame. The goal is truth and teamwork. If children are old enough, include them for part of the meeting. Let them learn that money is discussed, planned, and directed. Do not expose them to adult burdens in a way that creates fear, but do teach them real life. A household that talks about money wisely becomes harder to destabilize. Real-world example. Community Development Financial Institutions, often called CDFIs, exist to expand financial access in underserved communities. They may provide loans, technical assistance, coaching, and financial services to people or businesses that traditional institutions overlook. The lesson is not that every CDFI is perfect or that every borrower should take a loan. The lesson is that capital access matters and that mission-focused financial institutions can be part of community wealth building. Entrepreneurs of African descent should learn the local capital landscape banks, credit unions, CDFIs, SBA lenders, microloan programs, grant programs, business incubators, technical assistance providers, chambers of commerce, procurement programs, local economic development offices. Do not wait until you desperately need money to learn where capital lives. Build relationships early. Attend workshops. Ask what documents are required. Learn what lenders look for. Improve bookkeeping. Build credit. Understand cash flow. Prepare before the opportunity. Capital respects preparation. The wealth-building order. Every household is different, but a basic order can help stabilize cash flow. Know what comes in and what goes out. Reduce leaks. Increase income where possible. Build emergency savings. Create a cushion before every crisis becomes debt. Handle high-interest debt. Attack destructive debt with a clear plan. Protect the household. Use appropriate insurance, legal documents, and account protections. Invest for the long term. Learn retirement accounts, diversified investing, fees, risk, and time horizon. Build or buy assets. Business, property, intellectual property, tools, education, investments, and systems. Transfer wealth. Use estate planning, beneficiaries, teaching, business succession, and family preparation. Serve beyond yourself. Support institutions, scholarships, community ownership, youth training, and mutual aid with structure. Do not compare your order to someone else's highlight reel. Start where you are. A person in crisis may need stabilization first. A person with stable income may need investing education. A business owner may need bookkeeping before expansion. A parent may need insurance and guardianship documents immediately. The order is a guide, not a cage. Financial red flags. Protect yourself from financial traps. Be careful when someone promises guaranteed returns. Be careful when urgency is used to stop you from thinking. Be careful when you are told not to ask questions. Be careful when the person selling cannot explain risk. Be careful when a product is presented as a secret only insiders know. Be careful when family pressure replaces paperwork. Be careful when someone asks you to use your credit for their plan. Be careful when an opportunity depends mainly on recruiting others. Be careful when the lifestyle shown is louder than the business model. Be careful when shame is used to make you spend. Be careful when culture is used to silence due diligence. Trust and verify. Read the agreement. Ask for time. Get a second opinion. Check licenses and registration where appropriate. Understand fees. Know how the person gets paid. Do not let desperation make decisions for you. Wealth building requires offense and defense. This week's work. This chapter becomes real when you look at the numbers and create a plan. Set aside 2 hours this week and complete the following. Complete a financial inventory. Income, expenses, debts, savings, assets, insurance, and credit. Check at least one credit report and mark anything you do not recognize. Create or update a monthly budget. Choose one debt strategy: avalanche, snowball, hardship negotiation, or professional counseling. Set an emergency fund target for the next 90 days. Review beneficiaries on bank, retirement, and insurance accounts where applicable. Choose one financial education topic to study this month. investing, insurance, taxes, estate planning, business funding, or credit. Do not try to fix every financial issue in one day. Start by ending the avoidance. Declaration: I will not fear money, worship money, or ignore money. I will organize it. I will face my numbers without shame. I will learn credit, debt, saving, investing, insurance, capital, and estate planning with patience and discipline. I will turn income into assets and assets into options. I will protect my household with wisdom and prepare future generations with instruction. My money will serve purpose, family, community, and freedom. Closing thought: the ninth law of melanated success is this: give every dollar an assignment. Unassigned money becomes impulse. Unexamined debt becomes bondage. Unprotected income becomes fragile. Uninvested surplus loses opportunity. Unwritten plans become family confusion, but money with an assignment can build. It can stabilize a household. It can educate children. It can protect elders. It can fund businesses. It can buy land. It can create institutions. It can move from hand to hand with dignity instead of panic. Wealth is not built by income alone. Wealth is built when income is organized, protected, multiplied, and transferred.